If you're a Canadian homeowner and you are freaking out because of Trump's on and off tariffs, then this video is for you. To try and understand the specific ramifications of your mortgage and refinance of the Trump tariffs going on and off and on and off, today I'm going to break down specifically what happened with Trump and why this rally back to the stock market could actually end up costing Canadians hundreds of thousands of dollars, not thousands, hundreds of thousands of dollars. On April 9th of 2025, Trump made a decision to basically turn off tariffs for a large part of the world's economy, which brought the stock market back one of the biggest rises. The S&P 500, in fact, made one of the biggest rises, top 3 in history. This is actually insane news, and it brings back trillions back to the stock market. But what Canadians are missing is what the potential impact is on their actual mortgages right now and how this could actually cost you hundreds of thousands of dollars. So let's break it down and get right into it. I don't want you guys to wait. So what exactly happened? Trump slashed tariffs to 10% for most countries for the next 90 days, but he hiked tariffs to China to 125%, which is absolutely bananas, but probably not a surprise. A move which was aimed to actually work on negotiation leverage, as Trump likes to talk about, the art of the deal and negotiation. And if you follow Grant Cardone, you'll think he's an absolute massive genius. Now, I'm not going to get into that, but let's talk about what happened in our markets. Canada, we get some relief, but the key tariffs, steel, autos, and aluminum are still sitting at 25%, which is absolutely nuts. It is the way it is. The markets, I think, are confused, but they saw this as a temporary truce and a shift in the overall policy. Now, what does this mean for inflation numbers, which came in on April 10th? The US inflation came in a little bit cooler than was actually expected at 2.4%, holding things steady today with core inflation at 2.8%. Why this happened was primarily because of a fall in energy prices. So the US markets, I know we're talking about Canadians today, but it's important to understand the back end. US markets could breathe a little bit of a sigh of relief, but maybe not for long, and they're not pivoting quite yet. April and May data could be bigger, and we'll see what happens. Now, what happened here at home in Canada is what's more impactful to you. The bond market, which has been going up and down like a freaking trampoline the last couple of weeks, absolutely reacted and went up over 13 basis points, which is 0.13% in literally a couple of hours. Since the beginning of the day of April 9th to the beginning of the day, April 10th, the bond markets were up, the yields were up over 20 basis points. That's 0.2% in a little over 24 hours, causing many different banks and lenders to reconsider dropping interest rates, and may definitely have an impact on what happens in the rate market going forward. Now, mortgage rates themselves, at least advertised interest rates, those you see online, have not moved yet, but we're watching them very closely. Anytime there's this level of uncertainty in the marketplace, banks tend to place what they call a risk premium on interest rates, which means even if they could go a little bit lower, they don't, because of the risk of rates actually increasing. So why does this matter for Canadians, and how will it impact you if you were someone who has a mortgage right now who is thinking about refinancing? Let's break down the 6 different reasons why this strategy might not go well anymore if you're waiting too long. Now, the strategy I'm actually talking about is the possibility of refinancing your existing mortgage, replacing it with a lower interest rate, or taking out equity, or a combination of the 2 factors. Now, let's get into number 1. You really can't time the marketplace. A lot of people have been telling me, well, it looks like rates are going down. I think I'm going to continue waiting for rates to go down before I refinance or renew. Trying to time interest rates at this point right now is like playing hopscotch in the minefield with a blindfold. You just can't do it. As you've seen, the market moves fast. One headline, 0.13% basis points in literally 1 hour, which means rates going up and down nearly 0.15 to 0.2% in potentially 1 day. The second thing is opportunity cost is a real thing. If you right now are sitting with an interest rate of 5% or higher, then you're sitting on high interest debt, plus if you consider credit cards or other things, and waiting just means paying more interest. I've had some people say to me, again, with higher interest rates, I'm just going to keep waiting until the rates go down. Well, as long as you wait, you're just paying more interest. So this is called opportunity cost, the cost of waiting versus doing. You might save a little money by waiting, but you lose out on lost time, and that is something that you cannot recover. Number 3, and this is a big one, IRD penalties could get absolutely worse. If you don't know this already, you need to know that when you take a fixed rate mortgage and you break that mortgage, interest rate penalties can be massive. If the posted rates at the bank that you're working with drops and you're in a fixed rate mortgage, the IRD penalty can skyrocket to 5, 6, or 7% of the balance of your loan. Let's put that in context. $500,000 mortgage, your penalty could go from $4,000 to $25,000 overnight. And the irony, lower rates might actually increase your penalty, which would cost you way more than you think. The other factors, Not all lenders offer something called a float down. We talk about this all the time. One of the biggest mistakes Canadians make when they're trying to arrange a mortgage is they fight like tooth and nail to get a mortgage rate at the beginning, but then they might not close for 30, 60, 90, or 120 days. A lot of lenders do not do float downs, and particularly they don't do them specifically when you get to the end. That is something that we do. It's not automatic and it's not guaranteed. This is important to consider when you're refinancing, and a question you need to ask your mortgage broker how they manage that. Number 5, many lenders won't hold a rate long enough. Again, if you're someone who's saying, I'm going to refinance and close out, 6 months from now, let's say December, not every lender offers 3 to 4 month rate holds. I don't think people realize this. Some of the big banks do, but the more competitive rates that you see, they don't. They're typically 30 to 60 days or quick close products. And if you miss like right now and you delay, you're probably going to end up missing out. Number 6, property values themselves could shift. We've already seen people pull back from the market. It's not as busy as it was literally 30 days ago. And for that reason, if home values dip even slightly, you might not be able to refinance because you can only borrow 80% of the current market value of your home, not the market value last year, but the current market value. Now, my opinion on the fact of all this is that refinancing is not for everyone. And refinancing to reduce your interest rate and save money is also not for everyone. You need to run an analysis. We do this. Our clients get a monthly report and we do them custom. It's not about the perfect rate. It's about understanding your whole financial picture, your cash flow, and then the market timing and flexibility. Now, there's a lot going on in this market environment. It's not just about the rates, it's about the strategy. I think the biggest thing that you should take away from all this information today, US data aside, bond market data aside, is that don't let the headlines distract you from the real opportunities that are sitting here right now. Now, if you're someone who has a fixed rate mortgage above 5% and you're looking to see if it makes sense to run a refinance case scenario, we'll run an analysis. Just drop a comment below or send me a DM on Instagram at Flow Mortgage Co. or at The Mortgage Bug. And I'd love to hear some feedback for you. What do you expect to see next? And is this an opportunity that you think is ready for most Canadians? Drop that comment. I'll see you on the next one.